Welcome to The Explainer. Today, we're going to put on our detective hats because we've got a classic corporate mystery to solve. And our main clue? It's all inside one single crucial document. So here's the mystery, and it's a big one. You've seen this happen, right? A company blasts out headlines about record profits. Everyone's high-fiving, and then boom, a few months later, they're bankrupt. How on earth does that happen? Well, the answer's actually pretty simple, but it's the key to this whole thing. It boils down to one fact. Profit isn't cash. That's it. See, profit is kind of like an idea on paper, an accounting number. But cash, that's the real stuff. The money in the bank that actually pays the bills. And they are absolutely not the same thing. And that huge difference between what a company says it earned and the cash it actually has, we call that the profit paradox. To get to the bottom of it, you need a special kind of tool, something that lets you ignore all the accounting jargon and just, follow the money. And this is our tool, the statement of cash flows. Think of it like a nonsense detective. It doesn't get bogged down in theories. It only asks two questions. Where'd the cash come from, and where did it go? It's the ultimate truth teller in finance. The best way to think about this statement is like a story, broken down into three main chapters, or maybe three trails of evidence. If we follow each of these trails, we can put together the entire picture of what really happened with the company's money over the year. So these are our three plot lines. First, operating activities, that's the cash from the main day-to-day business. Then, investing. This shows where they're spending money to get bigger. And finally, financing, which is all about where they get money from, like investors or banks, and who they're paying back. Okay, let's start with the first trail, cash from daily business. Honestly, this is the big one. It's the cash a company makes just by doing what it's supposed to do. So how do we find it? Well, you actually start with the profit number. But then the real detective work kicks in. We have to make a couple of clever adjustments. We tweak it for things called non-cash items, and then we look at the changes in its daily accounts. Only then do we get to the real, actual cash flow. And this idea of a non-cash expense is really the key here. Depreciation is the perfect example. So an accountant might say, okay, our profit is lower by $70,000 because a machine got older. But hang on, did 70 grand in actual cash walk out the door? Of course not. It's just an accounting entry. So to find the real cash, we have to add that $70,000 back to the profit. All right, let's move on to our second trail of evidence, cash for future growth. You can think of this as where the company is placing its bets, what it's spending on to win in the long run. This part is all about the big moves. Did they spend a ton of cash on a new factory? That's cash out. Did they sell off an old building or some investments? That's cash in. These moves tell you a ton about what the company's long-term game plan is. Okay, to really see how this works, let's open up a case file. We're looking at some numbers from a company called Regal Ltd. Let's dig in and see what clues their investing activities give us. Right, let's break this down. First thing that jumps out, a massive $210,000 in cash spent on new assets. That's a huge bet on the future. They got a tiny bit back, $20,000, for selling something old. But now look at those last two lines. That loss and that depreciation, those were used to calculate profit, but they aren't real cash. Not a single rupee moved. They're just numbers on a page. And there you have it. This is a perfect example. If you only looked at their profit, you'd completely miss that they spent a ton of real cash. The cash flow statement tells us the real story. Regal is going all in on its future, spending a net $190,000 in cold hard cash. Okay, time for our third and final trail. Every company needs fuel in the tank to keep going and to grow, and a lot of times that fuel has to come from somewhere else. This is the story of where they get that funding. So this part tracks all the money moving between the company and its backers, its owners and the banks. Let's say a startup needs money for a big project. They could sell more shares or get a loan. In both cases, cash flows in. But when they pay dividends back to shareholders or start paying off that loan, that's cash flowing right back out. Okay, we've followed all three trails. We know where the cash came from, in the daily business, in their big investments, and from their financing. Now, let's bring it all together and solve this thing once and for all. And here's how the final report comes together. It's simple, really. You take the cash you made from your main business, you add or subtract the cash from your big investments, and then you add or subtract the cash from your funding activities. What's left over? That number tells you straight up whether your pile of cash at the bank went up or down for the year. And that's it. That's the solution to our paradox. A company can look great on paper, with huge profits. But if they're spending way more cash on new buildings and paying off massive loans than they're bringing in from their actual business, they can literally run out of money. And when the cash is gone, so is the company. It's that simple. So when you boil it all down, it's like this. The income statement tells you if a company is winning the game. But the cash flow statement, that tells you if they're still in the game. It's about survival. You absolutely need to look at both to get the real story. So, we'll leave you with a final thought. The next time you see a headline screaming about record profits, you'll know better, won't you? You'll know to dig a little deeper. Because a good financial detective always asks one simple question. That's awesome, but can you show me the cash?